Do you really think, after all the hype and promises, you can consistently outsmart Wall Street? Can you beat the collective intelligence and resources of the financial giants? Every day, we hear about someone, somewhere, striking it rich, seemingly overnight. Maybe it was with a hot stock tip, a lucky gamble, or a perfectly timed investment. But for most people, the reality is far different. Chasing that dream of quick riches is often a costly mistake, leading to frustration and financial setbacks. The financial world is cleverly built with all its sophisticated tools and enticing narratives to make you believe you can win, that you have a real shot at beating the system. But the truth is, beneath the surface, the odds are subtly but significantly stacked against you. Princeton economist Burton Malkiel spent his distinguished career meticulously proving that trying to beat the market through active trading and stock picking is, for the vast majority, a losing game. His seminal book, A Random Walk Down Wall Street, reveals, with compelling evidence, how the market really works, its inherent randomness and complexities, and why most people ultimately fail, despite their best efforts, to consistently outsmart it. So, are you approaching your investments with a well-thought-out plan based on sound principles? Or are you simply a gambler, chasing luck and fleeting opportunities? Let's learn the fundamental rules, the underlying principles of the investment game, so you can play a game you can actually win over the long term. Malkiel's core idea is the random walk theory. Stock prices move unpredictably, like a drunk stumbling down the street. Tomorrow's prices don't depend on yesterday's, they react to new random news. That's why Malkiel joked a blindfolded monkey could pick stocks as well as the pros. Studies back him up. Most fund managers can beat the market over time. The efficient market hypothesis explains why news is instantly reflected in prices, so you're always acting on old information. Technical analysis and stock tips, they're financial astrology. Accepting that you can't predict the market isn't defeat. It's the first step to becoming a smart investor. Play the long game, not the guessing game. Stock picking and market timing are the two biggest investing traps. You're not Warren Buffett. Most people who try to pick winners end up with losses and regret. The data is clear. Most individual stocks underperform the market. Market timing is just as dangerous. You have to be right twice when to sell and when to buy back in. Miss the market's best days and your returns plummet. No one can predict the future, and acting on fear or greed leads to costly mistakes. Malkiel's advice: stop trying to outsmart the market. Stay invested for the long haul. Harness the market's power by riding out the ups and downs. If you can't beat the market, with all its complexities and fluctuations, buy the market, embrace its overall performance, instead of trying to outsmart it. And you can do that with index funds. Index funds own all the stocks in a market index, mirroring its composition and performance. A prime example is the S&P 500, giving you instant diversification across a wide range of leading companies. And they do it with low fees, keeping more of your investment working for you. You don't need to pick winners trying to find the next big thing, or time the market attempting to predict its short-term movements. Just own the whole race, participating in the overall growth of the economy. Diversification is key. Index funds spread your risk, mitigating the impact of any single company's performance across hundreds of companies. Go further by owning international stocks, expanding your reach beyond domestic markets, bonds, and maybe real estate for a more comprehensive asset allocation. A diversified portfolio of low-cost index funds is the closest thing to a winning strategy, offering a reliable path to long-term financial success. Set your allocation based on your age and risk tolerance, tailoring your portfolio to your specific needs. Rebalance once a year and let the market work for you. It's not flashy, but it's proven to build wealth. The single biggest threat to your wealth, the silent saboteur that can derail even the most carefully laid plans, isn't the market itself, with its inherent ups and downs. It's your own emotions, those powerful forces that can cloud your judgment and lead to impulsive decisions. Fear and greed, the twin demons of investing, drive people to buy high, caught up in the frenzy of a rising market, and sell low, succumbing to panic during market downturns. This leads to repeating the same mistakes over and over again, in every bubble and boom and subsequent crash. So, what's the antidote to this emotional roller coaster? A well thought out, written plan, a roadmap for your financial journey that anchors you, providing a stable foundation when emotions inevitably run high and the market throws you curveballs. Know your goals, what you're truly trying to achieve with your investments, risk tolerance, how much volatility you can stomach, and time horizon, how long you have to invest. Do your research and due diligence before you invest in anything. Automate your investments as much as possible with regular monthly contributions. Invest in low-cost index funds. This is dollar cost averaging in action, buying more shares when prices are low and fewer when prices are high. And it keeps emotions, those pesky feelings, out of the investment equation. Be humble. You simply cannot predict the future with any degree of certainty. Be disciplined. Stick to your plan, even when it's tempting to deviate, no matter what the market throws your way. You don't have to beat the market trying to pick the next hot stock, you just have to own it, a diversified slice of the overall economy. That's how you achieve, over the long term, real financial security and lasting peace of mind.